This is Joel Solomon of PRS in the Roadmap. Today talking about qualified plan taxation and how an indexed universal life insurance policy might be a very powerful solution in order to take care of those projected future taxes at a discount. So let's explore this particular issue. Now, let's start off with the fact that a telephone technique for talking to a current client or to a prospective client is very valuable. This is something that we've fine-tuned over almost a 4-decade period of time. So let me share with you what I would do, which begins with identifying 20 current clients, putting their names and their phone numbers on a list, and or additional prospects, people that know and believe in you. So here's the telephone script. First, what we're going to do is we're going to chit-chat with the client. Then what we're going to do is say, hey, Bob, many of us are concerned about the volatility of the stock market and the corresponding impact on our pension, profit sharing, and 401k investments, and actually how it impacts all of our financial and insurance planning. I'd like to share with you a very exciting planning tool. It's interactive, and we can actually forecast the future value at retirement of your IRAs, 401ks, pension and profit sharing plans you may have based upon various assumptions. I can show you a projection of what distributions you can take out of those plans and the corresponding tax liabilities and how much you will have after tax each year during those retirement years. So with that in mind, what I'd like to do is get together next week to show you this wonderful planning tool. How does Wednesday or Thursday morning look for you? Now, this particular telephone script, I'm not suggesting you can't add or delete a word or two or maybe cough in there or something, but the point of the matter is I actually use the exact script that you see. Now, I've practiced it, and I would really recommend that you spend a fair amount of time making this extremely natural. So now the client has agreed to see you, or the prospect. Now, so let's take a look at these seeds. Do we want to save tax on these, or do we want to pay zero tax on all of this? The real issue is we do get to save taxes on the amounts that we put into any type of IRA, 401k, pension, or profit sharing plan. But as that money grows over time with tax-free growth, when you do pull the money out, as you're going to see in a moment, you get to pay tax on all of the harvest. You see, as I mentioned, when we put money into these types of plans, we get a tax-deductible contribution. We get tax-deferred growth. But every dollar you pull out of these IRAs, 401k, pension, and profit sharing plans are taxed as ordinary income at the applicable tax rates in effect at that time. So, as I mentioned, we get to save tax on the seed, we get to pay taxes on the entire harvest. Now we want to take a closer look at that. So look, every client has money in an IRA, a 401k, a pension, and or a profit sharing plan, Bob, just like you. So in order to actually put together a plan for qualified plan accumulation and distributions, the only things you need to know are his age. In this example, we're going to use a 45-year-old. By the way, what you see here is the input on the web-based roadmap. This is what that particular area looks like for inputting his age. You need to know how much does he currently have in those tax-qualified plans and how much is he contributing yearly. So under the tax-qualified plan asset category, we have the current value, $400,000, and the fact that he's contributing $20,000 a year. I like to use, these are defaults that we're going to continue contributions until retirement, and I use a 6% rate of return on qualified plan assets. We can debate all day long what the right rate is. Just leave the defaults in there when you first talk to the client at 6%. This is the output from the web-based roadmap. Step 1, projected future value of tax-qualified assets before retirement. So, for this 45-year-old with a $400,000 beginning balance, adding $20,000 a year, totaling $420,000 between now and age 65, and assuming this 6% growth rate, we would expect this client to accumulate $2.2 million at age 65. Now, Bob, when you're a client of mine, once we've put this in place into our roadmap system, we're going to get together each year. We're going to review what did you contribute, what was the actual growth or loss in the account, and are we plus or minus our glide path. Then we'll update it, because at that point we have a new balance which might be more or less than what we project each year. And we'll of course keep a record of all of these as time moves by, because this $2.2 million target is really our minimum target, but it will vary over time based upon changes in our investment assumptions, how much you contribute, and of course what the actual performance of these investments are over time. Now, step 2 of the roadmap, the output that is based upon the retirement income inflation rate. So let's suppose on the client's retirement income goal, we had a 2.5% inflation rate. That is our default that we have in our system, and I would encourage you to leave this there. What this means is when we take money out of his tax-qualified plans, each distribution will grow every year based on the inflation assumption. You'll see that in a moment. Also, the second factor that deals with distributions from the qualified plan is what we input as the effective income tax rate at retirement. In this case, we've put 30%. Notice the word effective. That means for every $100,000 that comes out, $30,000 is going to be the tax. This is not the marginal tax rate, effective tax rate. Total tax paid divided by total income. In this example, our default is 30%. So here's step 2, the output of the roadmap, the projected spend down of your tax qualified assets. So Bob, what's interesting with that $2.2 million balance that we projected at age 65, now going into the retirement period, and assuming that that money will continue to earn the 6% all the way through retirement, which in this example we're running from age 66 through age 90, we want to spend down the $2.2 million to 0 because we're going to assume death at 90. We want you to maximize the amount of money that you can spend. So therefore, the system calculating the spend it down to 0 does just that. It will maximize each year's pre-tax distribution. So what the system calculated is that the maximum distribution taxable that you could take at age 66 would be $128,000. Now notice how that grows by our inflation assumption. This is growing at 2.5% per year. So the web-based roadmap automatically takes this into account when you use an inflation factor on your inputs. If your inflation factor was 0, all of these distributions would be level. So you have the option of which way you want to do it. But for this particular case, we assumed a 2.5% inflation rate that was going to impact each year's taxable distribution. So Bob, in the first year, the system calculated with that $2.2 million balance that we could start taking out $128,000. Notice how it grew at the 2.5% inflation factor, and that $4.4 million of taxable distributions were taken out. Again, the pre-tax distribution is growing with the inflation assumption. Now, the tax, assuming this 30% rate, would be $38,000 in year one. Now, when we look at the cumulative taxes you would pay, would you believe it's $1,300,000 if you had a beginning balance of $2.2 million at age 66 and continued to earn 6% per year during this retirement period? $1.3 million in taxes. Now you understand what I mean about paying taxes on the entire crop. So let's take a look at how we can take care of these liabilities on a reduced basis. So again, focusing now on the taxable distributions and tax liabilities, you'll remember that these tax liabilities grew from $38,000 because we were taking out $128 in the first year of retirement. But with the inflation assumption, by the time you got to 90, you were taking out $232. So your tax liability at 30% is almost $70,000 at age 90. Again, when we are running an illustration, just so everybody's aware, we run the illustration with a number of requirements. The first one is that we solve for a cash value at the last year's distribution, in this case at age 90, that is equal to 2 times the payout. So since the payout is $69,633, our solve goal in the illustration system would be $139,000 at age 90. Oftentimes we'll just round it to 140. It just makes it simple for the case designer. So in this example, what we want the PennMutual policy to do is to provide tax-free income through withdrawals to basis and loans beginning at age 66 and running through and including age 90. The first year policy income, $38,499, matching the tax liability. That will grow at 2.5% per year since that was our inflation assumption. Now, what we're going to do, the second input, is to target the cash value to be $139,266 at age 90, 2 times that last year's distribution. We want a level premium until retirement, which in this example would be age 45 through and including 65, because retirement begins at 66. Generally, the target premium is 50% of the level annual premium. We find that this design works best for all concerned. We also have an illustration goal of having a cash surrender value at year 10 equal to or greater than 110% of the cumulative premium. So we'll come back to that. You'll see more about that in a moment. And as far as allocations, we generally suggest 25% to the fixed accounts. We want policy expenses coming out of the fixed, and 75% to your S&P index. Now, let's look at the actual PennMutual illustration to pay the projected tax liabilities on qualified plan distributions. So here's our PennMutual illustration. You'll notice the way Penn runs it is we would use an age 44 individual. We're going to use a preferred rate because this is going to give us an end of year 45 on the illustration. So again, with all of those targets that we needed to meet, the illustration system revealed a premium from 45 through and including age 65 of $16,358. So this would buy a death benefit of $394,000. We're always buying minimum death benefit in our cases. So again, we're going to pay $16,358 a year for 21 years, totaling $344,000. Now, look at year 10. What we want to do is make sure when we look at the cash surrender value on the illustration, in this case $193,000, is it greater than 110% of the cumulative premium, right? So when you think about this for a moment, Here we would have 163,000 of cumulative premium, so certainly the 193 exceeds that number. Now, what we want to do at that point is we want to take income from the policy to meet those tax liabilities, which come from step 2 of the roadmap, and you can see that happening right there. So when you look at the summary of all of this, the policy income from withdrawals and policy loans to pay those taxes are $1.3 million. This matches everything you see on these tax liabilities. There's the $1.3 million of cumulative tax liabilities. And since at age 90, we are taking out $70,000 or so. We want to make sure we have a cash value remaining of at least 2 times that number. So this cash surrender value remaining must be at least $139,000. Here we have $236,000, so it absolutely meets the goal. So your illustration folk at PennMutual know this. This is the way they will design these illustrations for you. We just want to make sure that everybody understands the why we build these the way that we do. So with that being said, Mr. Client, are you willing to allocate about $16,400 annually for 21 years, which would total about $344,000 in order to take care of that $1.3 million tax burden once and for all? Now, everybody knows that that's something that is a very easy decision. Also, we have the entire detail of the reasons why we do it the way that we do it, and that's included here as well. So, with all of that being said, thank you, and I hope you enjoyed why and how we use Index Universal Life to fund these projected tax liabilities on qualified plan distributions. This is Joel Solomon